Welcome, everyone. As I just heard, we have our final panel for you today. So, a very exciting one. So, hopefully, you guys are interested. The title of the panel is Central Bank Digital Currencies Possibility and Impact. So, I'm here joined with five other very interesting and unique individuals that have very likely differing views on the topic that we have today. So, hopefully, we have a good amount of debate. One of the things that I really enjoy about panels is having a bit more of a different viewpoints so that everyone isn't always in agreement with everything, right? So, do share, those ideas, those viewpoints that differ from your fellow panelists. They won't get angry at you. It'll actually make for a more interesting conversation. So, to begin with, a quick introduction to each of my fellow panelists. So, I'm also here joined by Thomas Hu, who's the founder and CEO of Kyber Capital. Stewie Zhu, founder and CEO of Distributed Credit Chain. Ryan Terribilini, co-founder and president of Formosa Financial. Stanley Yong, CTO and global lead of IBM. And Matthew Cannon, co-founder of Redpulse Capital. And so we'll just have a quick 10, 15-second intro just so that you can share a little bit more about your interest in blockchain and how you got started in that.
Hi, everyone. My name is Thomas Hu, and I run a boutique investment firm called Kyber Capital. We make early-stage venture investments into cryptos and blockchain space. We've been doing this since 2015, so we've been early in the space before people were talking about blockchain outside the cryptocurrencies context. And for the record, we are not affiliated with Kyber Network, which is a very successful ICO project out of Singapore. We were actually founded earlier than Kyber. The reason why we share the same name and potentially a similar logo, I guess, coincidentally, is because we are all fans of the Star Wars movies.
Hi, everyone, and thank you for giving me this opportunity to share my views here. I'm Stewie, and I'm the founder of DCC. We are providing a new credit data transforming protocol. Which is different with original like centralized data transferring protocol. So we just been listed in 2 weeks ago. We are new projects. So thank you.
It's an honor to be here with such esteemed panelists today. Thank you for putting all these great questions together, Jonathan, and thanks to the organizers. Andrew's done a great job along with Congressman Xu and other esteemed guests. So I first came to Taiwan about 5 or 6 years ago, and at the time I was actually working for Google in the 101 office. In that role, I was focused on global policy and operations, and a big part of Google's business for the global app store was payments, and that's what led me to look at blockchain as a potential way to overcome some of the payments problems that Google was having as Android was scaling across the world. So that led me to work at Ripple for 2 years, where I worked with developers and banks on implementing blockchain solutions for financial technology and payments across banks. And now Ripple has gone on to do trials with central banks. So that's my interest in this subject. And I recently founded a company called Formosa Financial, and some of my team members are here today. We're focused on banking solutions for blockchain innovators. So please come talk to us.
Bit of innovation there. Hi, I'm Matthew Cannon. I'm co-founder of Redpulse Capital. We help young ICO companies, pre-ICO companies, post-ICO companies navigate their way through the whole myriad of processes to do successful and compliant ICOs. Some of that is token economics, advising on business models, governance models, KYC frameworks, etc., etc. My background, a year ago today, I left a banking role. I was the treasurer of HSBC in Singapore, responsible for all of the trading activities and the funding and liquidity management of the bank, which involves a lot of interaction with the central bank and the way in which monetary policy kind of travels between the banking network and central banks, which I guess may be why I'm sitting here today. Thank you.
Hi, I'm Stanley. I'm with IBM as the CTO for the IBM Blockchain for Finance unit. Prior to joining IBM about 7 months ago, I was in the MAS for 10 years. That's the central bank in Singapore, where I was in charge of innovation acceleration in the fintech unit. And that's how I got involved in Project Ubin, directing that project, which is around central bank money on blockchains. looking at the benefits that could come from that. So in a very concrete way, looking at, in particular, on privacy models and different permutations that you could use for that.
Great, appreciate it, guys. And quick intro to myself. I'm the founder and CEO of Redpulse, which is a tokenized research ecosystem focused on China. And my personal interest in this also is that as part of our token economy that Redpulse launched, we have a inflation agent. So much the same as a central bank, we're able to mint new tokens, or as central banks do, print more money. So there's some interesting corollaries that we can go into on that topic. So to begin with, wanted to start with more of a definition, setting the tone as to central banks and cryptocurrencies in general. So the purpose of a central bank, and this is from Wikipedia, is to manage a currency, to manage the monetary supply, and to set interest rates. So those are the key three things that central banks do. And I wanted to start off with a question as to how are central bank digital currencies going to fit in with that current role that central banks have?
I think I'll start. To follow up with that definition of a central bank, I think that some of you may find in most of the macroeconomic textbooks about central banking, you will read about the mandates of central bank is to be maintain the price stability, financial stability, and monetary stability, and sometimes banking supervision. So that basically encompasses what a potentially more digitized economy in that world, how would a regulator should look at this digital world, and in what way and form a digitized version of currency instruments can be utilized to facilitate all those goals. Now, a central bank may or may not want to utilize this digitized version of those financial instruments to facilitate those goals, mainly because it's outside their legal mandate. Now, if they are allowed to expand their legal mandate to encompass those goals, it remains to be seen whether or not they are technically available or capable of facilitating those goals to the greater good of the society. So I think right now, this entire movement of digital currency is forcing people to really think hard about what roles central bankers should play in the current political context. And bearing in mind, though, if you look at the history of human civilization, the central banks is actually not a very old institution. It's actually a very modern creation. Now, it's probably only at most 400 or 500 years old, and still, in my definition, a prototype, just like any other cryptocurrencies. It's just that they're here longer before the cryptocurrencies, but whether or not cryptocurrencies can become a more viable model of governing our economic activities, only time can tell. But I think that we're getting there.
So yeah, as Mr. Hu said, so fiat money for me is not very new actually, because only in 1971 we got rid of the golden standard. So a little bit of my experiences or opinions about in China mainland is like I think we want the national-based cryptocurrencies, but it will be not very fast to expect that happen, because like there were a lot of like things to be discussed, and it also considering the problems about the foreign exchange, because Chinese yuan, they always want to beat the US dollar to be the world #1. So it might be an opportunity for the Chinese, People's Bank of China to achieve that goal. So in my opinion, there will be way more solid, investigations or discussions about that in China. Yeah, and
it's an interesting viewpoint. So you might recall that the RMB was not too long ago entered into SDR basket, special drawing rights, right? And a lot of people actually thought that it was a bit premature because the RMB may not be fully internationalized in the sense that these other, constituent currencies in the basket are. So any interesting views on that? Or that in itself is an interesting view. Okay, so
it does only account for about 2% of global trade settlement, the renminbi, that is. So it does seem premature in that their weight in the basket, I think, is around 10%, if I'm not mistaken, or
Yeah,
5%.
yeah,
So
so pretty
it seems to be outweighing its actual value right now, but it's probably a forward-looking inclusion in the basket, I would imagine.
I mean, to your previous point, that if you think about the history of IMF, right, it's supposed to be a supranational entity that will facilitate the global provisioning of credit. And to some extent, the inclusion of whatever fiat currencies into the SDR basket is more of a political decision rather than an economic decision historically. So you can see that ultimately, if renminbi can be included into the SDR to reflect the economic realities and the ascending political reality of China's influence over the whole world, then wouldn't it be possible eventually that a digitized form, i.e. cryptocurrency, will become a small allocation of this basket? And in fact, if we do believe that internet as a supranational infrastructure providing global public goods, and I think it makes perfect sense to have a allocation into that basket just to facilitate this kind of a movement down the road.
Interesting thoughts. So switching gears a bit, I do want to get back to what benefits that central banks draw from having their own digital currency. So either benefits or problems that they solve.
Let me say something there. I think when we talk about central bank digital currencies, there are various different types and they're not at all similar. So if you consider money, cash, to be what is being replaced by the digital currency, and that cash is effectively now a wallet which is held by the individual at the central bank and allows that bank to bypass the commercial banking system and effectively hold their cash as a unit of exchange that they can conduct their day-to-day transactions without the use of a banking system, as is envisaged by the system in Sweden, for example. That is what I would consider to be a replacement of notes and coins. If, on the other hand, the version of the central bank digital currency is, for example, the one that is envisaged in Singapore, which is effectively an interbank settlement system, that really doesn't convey any of the kind of benefits to the individual of enabling them to choose to bypass the banking system or to transact on a peer-to-peer basis without having to use a bank. The key issue for me, if the bank issues actually the equivalent of digital cash, is around privacy. And for me, the ability to use cash and to be able to transact without anybody knowing and following and looking back upon what I've done with my money is a very important personal freedom. If you take the example of, I don't want to pick on Hungary, but the recent change of rules in Hungary that have made it effectively illegal to assist migrants. If I had in the past used my digital forint to give a donation to a migrant, could I then subsequently be chased down by the authorities for having done that thing? And I think those kind of questions about what is the nature of the digital currency and therefore, what does it do and what influence does it have on an individual's privacy are key points. And we shouldn't assume that the central bank needs to take a leap into individual freedoms in issuing digital cash. The motivation for issuing digital cash may just be that it's actually cheaper and more effective than issuing paper notes and coins. But it doesn't mean that the central bank has to track people and track transactions. And I think it's a very important part of the discussion to say, well, actually, let's not start with the assumption that this allows us to be tracked.
I think it's a fair point, but how likely is it that...
Unlikely.
There you go.
Well, I wouldn't say it's entirely theoretical, actually, because last summer I was in India doing research, and this was about 8 months after Modi's government had decided to do a demonetization policy. So in that policy, they essentially removed 85% of the cash from the money supply. The purpose of that is disputed. They're kind of evasive about it. They say it's a big digitization drive for the government to modernize India and things like that. But the underlying political reasoning seems to be increasing tax compliance on some corrupt oligarchs who might have been storing black money in other places. So you can argue with their methods and what happened, but at the end of the day, I think the example you bring up is relevant in that it does have a lot of implications for privacy and how governments go about implementing digital cash systems and what that means. It doesn't even have to be blockchain based necessarily. Just the idea of taking cash so that people put it in a more digital form, which is just commercial bank money, also has relevance. Yeah.
So the big question around privacy of any kind of online-based currency system is that automatically you have the side channel attacks, right? So side channel attacks mean that I don't have to observe on the blockchain who spent that money. I can just observe your phone traffic. I know when you sent out a particular transaction, unless you're using some other form of obfuscation, I can see the timing of that transaction that's been propagated on any blockchain. I can still trace it back to your IP, your phone number, somehow I'll find you. So using a cryptocurrency alone doesn't assure you privacy in these respects. And if we think about the use cases that, say you wanted retail participation in digital currency, then arguably some of the models that have been tested out long ago from Chom with blind signatures, where you have the ability to transact with true privacy on a peer-to-peer manner without even being online necessarily, might be more useful. So I think, part of the assumption that all of us are making when we talk about central bank digital currency is that it's going to be based on some kind of blockchain platform. Whereas in reality, there are many alternative ways to implement this without using a single source of truth, without using a blockchain. And arguably, some of these designs make more sense because they allow for offline transactions. They allow for much higher scalability because they don't rely on coordination across millions of participants.
Very good points there. And just to have a quick recap of what Stanley just mentioned, I think it's really interesting to point out that the discussion on whether there is going to be protection of privacy of individuals' rights, it may not be even an actual point. It may be moot in essence, because as you mentioned, being able to track someone's IP, MAC address, it's a reality, right? So having paper cash, having coins, that truly is private, in a sense, where if you have it in hand, you can perform a transaction without anybody else knowing about it. But when we're talking,
even that, you can leak information, right? I could trace your DNA on I could find some way to mark it. And you could have chemical traces, which is what happens when you steal money from an ATM.
That's kind of going a little bit extreme.
No, but if you stole money from an ATM, the ink packet will explode, and then
with every other person who'd handled that note,
Well, but I mean, yeah. So still, there's a.
I think that's a ridiculous. In fact, it's a kind of a ridiculous way of arguing that you don't have the same amount of freedom when you use cash and the same amount of privacy when you use cash as you do.
Hence, we talk about money laundering,
transactions,
right? Which is money laundering. So you wash the money so that you're sure that there's no trace of you on that.
Always welcome differing viewpoints. So the other thing that I found quite interesting that Matthew, you mentioned earlier was the usage of cryptocurrency as a replacement for dollar bills or any sort of currency bills and coins versus interbank transfers. And I think there's another one which we wanted to touch upon a little bit later on, but we can jump straight into, which is credit, which is lending, right? And the way that money works right now is that when you deposit $10 in the bank, you believe you have $10 there, right? And then you believe the bank, you trust the bank. But the bank just very quickly turns around and lends out that same $10 to somebody else. So that $10 became $20, right? And so that person that you lent it out to, they themselves could also be lending it to somebody else. And so this money flow, this velocity of money is helped by the fact that you can lend out, the same dollar many times over. And when we switch to a digital currency, a central bank digital currency, what, if any, impact will there be on lending? Either consumer lending or corporate lending.
Yeah, this is a very good point that you make, and I think one of the key obstacles to central banks issuing digital currency in the form that the Swedish form, where you effectively take your cash out of a bank account and hold it directly with the central bank, because the effect of that is that the banking system has a lower amount of deposits, and as a result of having less deposits, they would, all other things being equal, have less lending capacity, and then the banking system is not able to provide the same amount of lending as it would be able to do, all other things being equal, in its current state. So there's different ways in which the central bank could address that. One of them may be to lend that amount of cash and liquidity back into the commercial banking system to facilitate them to re-lend that. But then that starts to become a kind of centralized system of credit, which is kind of not very fashionable in a capitalist type of a society. But another way of looking at that is that the way in which banks calculate the amount that they're able to lend based on their deposit base is based on a kind of a behavioralization model of those deposits. So they look at the character of those deposits. And it may well turn out to be the case that if people move cash into a digital cash held with the central bank, the nature of the money that is left in the banking system is actually more stable, and a higher proportion of that money can be relent, and the effect on credit capacity might not change. But actually no one knows. They don't know what the extent of those changes will be.
Yeah, I think one of the key challenges facing the entire industry on the adoption or potential adoption of a central bank digital currency is the fact that we operate in a highly leveraged system where fractional banking is a reality. So any policy decision with regards to the selection of policy tools will need to face that reality, that you just cannot simply just say we shut down one system, they are supporting multiple credit issuing mechanism, and replace that with a new form of trust mechanism, built upon some kind of digital or distributed ledger. So I'd agree with Matt that ultimately there are many ways to go about facilitating payments or provisioning credit. But I think the key question here is for central bank to realize their policy goals, whether it's maintaining prices or raising rates or boosting employment, or even telling their banks under their supervision to behave. Will a distributed ledger technology be useful in all those regards? And will consumers and citizens benefit by the adoption of such a tool? And whether by using better technology, we can create different routes for payment facilitation and the clearing and settlement of payments, as well as the provision of credit, without encroaching or encumbering on the ability of commercial banks or any non-bank lenders in issuing credit to the economy for productive uses. And that is a very key question and a very important challenge I think the entire industry needs to answer.
So I think if you look at the Vogel proposal by the Swiss, right, which was voted down, that envisages a world where you go back to narrow banking and then you have credit extension being done by the investment banking system effectively. So there are alternative models for these things, which people have thought through, and no one's dared to put into operation, clearly. But I mean, it's not a uninvestigated field, right? So maybe a thought experiment as to why cryptocurrencies may be somewhat useful. If you think about a central bank's reserves today, how do you know what the central bank says it has in its vaults is true? You have to trust, basically, that this central bank has enough foreign reserves in gold and what other certificates to back its promises as to how much of these things, the convertibility of that money into value is possible only when you have a certain amount of assets that back that, the liabilities extended to the public. Now, if you go to a cryptocurrency world, you no longer have to trust the central bank. If the central bank's reserves were entirely in Bitcoin, Ether, and so on, you could literally, and they listed all these addresses out where they hold these reserves. At every single point in time, you could go back and look at the ledger and know precisely what reserves they held in whatever form it is, and know that every single unit of its currency that's been issued, which is a basket of these cryptocurrencies, is fully backed. So this is a fundamental change in how things could work. Of course, no central bank is going to hold all its reserves in cryptocurrencies, but this is a very, very different change from what we have today, right? I mean, what's the best you can do today? Trust on a camera that you put in someone's vault to look at all the gold bars that are inside, count them all the time. What if someone interferes with the feed? What if someone just replays the video? I mean, you don't know any of that is true.
It's an interesting point. So there is a precedent for that. I believe it's the second largest ETF by assets right now. It's the gold ETF run by Spider, and they do that. You know, every year or two, they literally have an auditing firm come and count the gold bars to make sure that it is truly physically backed. But of course, you have to trust the auditing firm, right? You have to trust the people that are in there counting the bars, not having miscounted or misplaced a bar. So you're right. You know, there still is quite a lot of trust that is required in today's current framework, but perhaps with digital currencies that could change. The other thing I wanted to bring up and ask the panelists is, any other anecdotal cases where central banks have already been quite aggressive in using blockchain, using digital currencies? And you mentioned, you know, Switzerland, Venezuela might be an interesting use case given the hyperinflation that's going on there. But any other countries come to mind that are either very much on the avant-garde or perhaps a bit slower to adopt?
Well, certainly we've seen a lot of privatized or private central banks, where central bankers want to be trying to issue their own stable coins in the world of cryptocurrencies, simply because they see a very unmet demand that a stable coin as a conduit for payment or the store of value and the transfer medium for wealth are just not cut off for it yet, given what's available in the market. But to call themselves a very stable or trustworthy provider of such an instrument, I think, you know, it's remained to be seen whether or not they can stand up to the test. Because if you want to issue your own currency, you got to be prepared to defend it when challenges come. Ultimately, the market will try to see whether or not which stable coin will serve its design purposes. And ultimately, I think that some of these stable coins will find its place maybe in the mixture with a more official version of the central bank digital currency sanctioned by the government. And ultimately, society will learn how to coexist with all these currencies and let the market decide whether or not those varieties should be allowed to exist.
But isn't that the critical point, that a stable coin issued by a bank is commercial bank money? Ultimately, you don't get all that confusion and worry about credit. So it might be just a more viable model, easier for a regulator to swallow, because it's just e-money, which is already something that they well understand.
Yeah, I think it's probably more of a more inclusive way of licensing to a bankers want to be in a very narrow sense, just to issue a particular form of stable coins to facilitate a very particular form of transactions. Now, whether or not we can allow that, again, you know, remains to be seen.
I mean, so are you talking about fully backed stablecoins or fractional reserve stablecoins, right? Because both could exist. In fact, you could have zero reserve stablecoin, which is just the bank printing money.
Yeah, I think right now most of them are trying to be like a fully backed reserve coins, right? But then on a fractional reserves type of instrument, again, going back to the commercial world. And so, you know, why don't we just trust a bank? Even though bank may not always be trustworthy, at least we have a way to correct them. Now, we don't really have that measures available to a lot of the stable coin operators. You know?
And how would you define fully backed, by the way? Fully backed versus fractionally?
So fully backed by some kind of collateral, right? So you may over collateralize it when you point to X amount of gold bars equals this number of USD tokens that I'm going to issue. Or you could literally back it with $1, right? For $1 token.
Or in the case of Venezuela, how many barrels of oil?
Right. Yeah. But the thing
that
is,
that needs proof of reserves too. I'm not sure how they're going to do that.
I mean, and I think the difference here is between fully backed and not fully backed. I mean, the existing regulatory framework for banks around leverage ratios, liquidity ratios, capital adequacy, etc. If you issued a not fully backed token, it would effectively be a liability of the bank, and it would come into the bank's liabilities, and it would be, you know, managed according to the existing framework that is there. if you issue a fully backed coin where that money is client money and held in a segregated custody account, that's a completely different instrument from bank credit, in my opinion, right? So that, you know, they're not the same thing.
Right. But isn't it true that most currencies, most fiat currencies, are then not really backed by anything physical, substantive, right? So
I believe that to be the case.
right, right. So is this really that different than what we're talking about today about
Except
using-
you're holding the commercial bank's risk versus the sovereign risk, right? So the fiat currency, you're holding a liability of the country's central bank.
If you hold a fully cash-backed coin that is actually issued by a bank, but where the cash that is backing it is held by a segregated custodian, then it's not really bank risk. I mean, there's risk in there, there's
Right.
operational risk, but it's not credit risk on the
So
bank.
the commercial model behind that fully backed coin is the thing that falls down usually, because why would, unless you're charging fees for use of that coin, why would a bank go to the extra expense of having fully backed, locking away these funds, 100% or more of the funds? To back something?
I would absolutely love to run a bank whose sole job was issuing a cash-backed cryptocurrency, because I mean, it would be absolutely beautiful. I would pay no interest on the cryptocurrency. On all the cash that I held in reserve, I would deposit and buy short-term government bills and earn 2% on. You know,
But you're buying bills, right? So that's the thing. You're buying something that it's not fully cash backed. It's backed by something that's cash-like, but not cash.
Or cash
You see,
equivalent.
that's exactly the thing. The point I was saying is, you have that issue, and then you
But
may have to
even if
overdraw.
I mean, I could put it in my, you know, variety of. So you've got some credit risk in there. You're right.
Okay, interesting debate. So now that we're talking about, you know, the adoption of digital currencies by central banks, what is the impact potentially on current legislation and regulations? We've seen some come out mainly on private industry, right? So these are companies, these are projects that are launching their own cryptocurrencies. Is there any sort of corollary between the two? Is there any sort of connection between the regulations that have been set forth already tied to the cryptocurrencies that central banks themselves may launch?
I think because it involves all the monetary policies, you know, those big stuff. So like it's and for me, like a Bitcoin itself is like a social experiment. So if we talking like too many like a specific thing about like how do we set up this like a central bank, you know, digital currencies, it would be like early, especially for like in my case for big countries like China. So the process will go very slow. So it will be always the private sector first, and some like a tentative move for central banks or for regulators. I mean, China, it would be maybe we propose some tokens just for facilitate the interbank services. I mean, between financial institutions or licensed, you know, financial institutions. Then we start to, you know, investigate the interactions between this token to all the private sector around, you know, tokens. Then we start to discuss the possibilities of start a staple token. My logic would be something like this. Yeah.
I mean, if you look at the way the entire financial system is currently being regulated and managed, I will argue that it's actually very indirectly regulated and managed in terms of consumer-facing functions. The central bankers regulate commercial banks who issue credit or make loans and invest into businesses or the society. But central bankers do not directly regulate or manage each individual's balance sheet or bank account. Now, with the availability of a central bank digital currency, theoretically, a central bank could regulate and manage your own bank account, every individual. Now, do we want that mandate to be expanded and given to the central banker who may or may not be always accountable to a democratic political process? I think it's a more important question. Now, if we allow that, to happen, then what will mean for our daily lives? I would argue we just look at what mainland China is nowadays, right? You have Tencent, WePay, Alipay, and a lot of those things are happening, almost instantaneously. But in fact, it takes many years to develop the technology and the habits behind. But once those technologies are in the field, right, with a smartphone and almost a lot of these smart devices, it can mingle with your daily life seamlessly, and that's enormous power. And are we ready, or are our laws and regulations ready for that kind of a power to be held accountable, and we can be responsible in that kind of environment? Again, it's a big question. I think it remains to be seen whether or not central banks are ready to take on this challenge directly.
So I think we need to take a step back. Why does the central bank have the right to regulate a commercial bank today? And if you look at the history of why they have a right to do so, part of it may be statutory. There's a law that says so. But most of it is because of the fact that the central bank plays the role as lender of last resort. Now, in a central bank digital currency world, theoretically, if the central bank is going to just operate as a narrow bank for everyone, and only commercial banks extend credit in future, then what hold does the central bank have anymore on those commercial banks, unless the law says so, right? So it no longer has to act as lender of last resort, because you don't have to safeguard the payment systems anymore. You operate the narrow bank for everyone. If a commercial bank goes down, so be it, right? In this world with the central bank digital currency. Likewise, say the FDIC, SDIC, or whatever deposit insurance scheme, why do they have regulatory powers over banks? Again, because they make good on insurance. They have to pay out on your deposit. Now, in the central bank digital currency world, if bank runs cannot occur anymore because you can't run on the central bank, then what hold does the SDIC or FDIC have on the commercial bank? None. So I think in a central bank digital currency world, what banks will do is they will lobby for a relaxation of regulations, and rightfully so, because there's no need for any of these functions and hold over them.
Interesting viewpoints. So I think also to answer Thomas's question, somewhat rhetorical perhaps, which is, should we allow central banks to have that degree of oversight and management over individuals, essentially, balance sheets or assets? I think for most people the answer is hopefully no. That I'd like to have some degree of privacy, right, and be able to manage my assets as I see fit without having someone oversee me. But I think what that then likely supports is the idea that private cryptocurrencies are here to stay. That there isn't going to be this wave of central banks that all launch their own digital currencies that usurp, the Ethereums, the Bitcoins, the Ripples of the world, right? And with that thought in mind, how might these different types of cryptocurrencies interact? Because if we are getting to a point where different central banks are launching their own digital currencies, is there a go-between? And what does that look like?
Yeah, so I think there's a couple interesting use cases that lots of central banks would be interested in when it comes to cross-border payments and actually settling between central banks. So you could imagine a series of central banks having their own digital currency, and then what we would know in the crypto world as a cross-chain atomic swap is something similarly facilitated by continuous link settlement today. But the issue with that system today is that it only operates on a 5-hour window every day. So if we had a series of central banks with all these currencies, you could be swapping interchangeably for foreign exchange payments between actors across different markets. It could be very interesting.
Yeah, to echo Ryan's point, this cross-chain capability is actually an area into which we look very closely at right now. I think it's a very important key area for future investment and ongoing investment as the entire economy, and especially the financial economy, becomes more and more data intensive and digitized and secured by cryptographic conduits and all that. But the important things here is that once the market is accelerating and evolving faster than regulators can catch up with, then those market forces will promote and force certain entities to become even more powerful than it originally set out to become. And at that point, the government may or may not want to step in, but maybe the occasion may arise that will force them to step in and try to figure out a way to regulate or legislate a set of codes to make these entities more responsible and accountable to the eventual failures that may happen.
So I think one step back again, in order to get that world that Ryan is talking about, what you have to do is basically take Matt here and then boil him down into an AI algorithm, because what you are saying, if you have continuous link settlements 24/7, is that Matt is working 24/7 because he has to manage the bank's liquidity position. So unless you can take all his goodness and boil it down to an AI algorithm, we are still not there yet.
You might be able to do that, right?
If all the money's on a blockchain, the data's there. So just use the data set, right?
Yeah.
So if I can end on just one last question, a bit more of a survey actually, rather than long form. Looking at all the different constituents right now, the different stakeholders. We have central banks themselves. We have the various countries that have a central bank each. We have individuals. We have corporates. We have companies that work in blockchain and the crypto space. So if you were to choose one winner, the one that would benefit the most in the short term, which one would it be? And we'll just have a quick short answer. And if you want to back it up with the sentence, that's fine, but keep it short. I was curious what each of you think on this topic.
Well, it will be people. More selection, more choices, more varieties, but you got to be wise about your selections. You got to be very smart about what you choose, because at the end of the day, your choices will dictate, what kind of a world we live in.
Okay, so Thomas says individuals.
Individuals too. Then people don't have to buy USDT, right? If they
That's right. Nobody would have to buy USDT, right? So okay, Stewie also says individuals.
Short term for me is the central banks, because I feel like the type of implementation of this type of program would be more focused as a tool to improve their monetary policy, to look at velocity of money and kind of lowering settlement risk amongst their constituent banks. So I see central banks short term.
All right, Ryan for central banks.
So I'll try and say something different, because individuals will.
Please,
but,
yeah.
If it is the case that central bank digital currency is held by individuals in their own central bank wallet and withdrawn from the banking system, the nature of the relationship between the individual and the bank changes. When you put your money back in the bank, it's a form of kind of medium-term deployment, if you like, of the excess liquidity that you have as an individual. When you start making decisions like that, the bank is just another alternative to a peer-to-peer lending platform, or another kind of fintech credit intermediation platform that provides the individual with a range of different choices about where to deploy the funds that they don't need immediately. So those kind of peer-to-peer platforms could become quite interesting.
Okay. So Matthew says peer-to-peer platforms. And Stanley?
I agree with Matt.
You agree with Matt? Oh, hey, okay. I'm glad somebody, or at least the two of you, can agree on one thing. I was a little bit afraid it was going to go into a fist fight here. Okay, well, thank you very much for joining us today. And let's give a round of applause for all of our esteemed guests. Thank you.